Hi, I'm Joe Parcell with the College of Ag, Food and Natural Resources at the University of Missouri. Welcome to this segment of Take One for Ag. Joining me today is Dr. John Kruse, Associate Professor of Ag and Applied Economics and also associated with the Food and Agricultural Policy Research Institute here at the University of Missouri. John's joining us today to talk a little bit about the WASDE report that came out in January, John. Some kind of big anticipated report with some, everybody's anticipating what's the production actually going to be. So let's kind of jump right in there if you're okay with that.
Sure.
Yeah, let's talk about corn, first of all.
Well, the January WASDE report didn't really have a lot of real exciting news. If you look at the way the markets reacted, it was a slight positive, even though some of the results were slightly negative. So it's kind of interesting how the market reacted. Maybe the report wasn't quite as pessimistic as everyone was expecting. If you look at corn, in particular, the WASDE is calling for a $3.85 season average corn price for 2019-20. And that's actually 25 cents higher than last year at this time and almost 60 cents higher than 22 years ago.
Well, farmers right now take any kind of good news, and it sounds like a little bit of good news there. Yeah, you mentioned there kind of some mixed messages. I think usage down a little bit because of exports, but yet a little bit of a drop in ending stocks that probably drove up that price. So let's shift gears now over to soybeans. What that WASDE report have for soybeans, and is FAPRI seeing anything different looking out in the future there? So.
Well, as we, for one thing, again, the report itself, it did not include any impact from the trade agreement built in specifically to the report. So it really didn't give us any insight on that. What did happen, though, after the report, and after the announcement about the U.S.-China trade agreement, we saw soybean prices decline relatively significantly, down now almost 60 cents a bushel. And a lot of that decline kind of reflecting some uncertainty around exactly how the volumes will get set in terms of how many soybeans will we additionally be able to sell to China. It kind of looked like there was a piece of the report that said based on market conditions, and so it really looks like we may not have much in terms of enforceability or what that means exactly for soybeans. So that's part of the reason we had such a decline in prices.
Yeah, so getting a trade agreement signed versus all the processes to get it in place are tale of two different coins here, it sounds like, and the market's yet to determine where that's headed. So we're going to shift gears again, a little bit about wheat. We grow some wheat, at least here in Missouri in the Midwest, and important crop across not just the U.S., but really across the globe. So any surprises there in the report?
Well, I guess the biggest surprise may be just actually how little winter wheat actually got planted. It was technically a little bit up, about 1% from last year. But if you look at the state of Missouri, for example, this is the second lowest winter wheat plantings. We've taken a pretty sizable hit there on our wheat area. As we look at prices for 2019-20, the futures market has gradually been creeping higher. We've been suggesting it's been an opportunity to price some wheat. Going in as we look into next year, we are expecting that price to come down. And so it does look like an opportunity for farmers to price at this time.
Okay. Well, again, a little bit of good news. We'll take it out there in farm country. So let's completely shift gears. Let's go into livestock a little bit. So we know here in the U.S. we've been growing our production quite a bit. 15 billion pounds from 14 to 19, or projected into 20. Is that domestic or is that international trade? What's driving that? And what's it look like going forward?
A lot of the past few years' growth that from about 2008 really through 2019, a lot of it has been domestically driven. And so what is perhaps a little more risky looking out the next 5 years is more and more of that growth is dependent upon exports, how we can export. And there might be an opportunity right now to, at least in the short run, to get some pork exported to China. There's still some debate about what the tariffs and whatnot, but there may be a window here in the next year. But after that, China's pretty aggressive on their plan to recover from African swine fever. And so when you look at how quickly they plan to do that, they expect to be back to normal by the end of 2020 and then if there's any additional catch up, that will be done in 2021. That's a pretty aggressive plan. So that may be what actually limits our window over the next few years.
So kind of maybe a little bit of an underappreciated part of FAPRI is they don't have to just look at the domestic market going forward. I mean, you got to look at this global market because of the different economies and everything from a Brexit to a health issue to whether it's in animals or humans out there or trade agreements. So
we are increasingly dependent upon international agriculture for really the globe in terms of where our demand is coming from. And if you look at a lot of the FAPRI forecast or any USDA or others, you'll see a lot of the demand growth is in the export side for the United States. And so that's what our farmers are becoming increasingly tied to, and it's what makes it a little bit riskier for them.
All right, John. Well, I want to thank you for joining us today on Take One for Ag. So, and to our viewers, I want to thank you for joining on this segment of Take One for Ag. If you want to search out past issues or segments of Take One for Ag, go to our YouTube page or search on YouTube Take One for Ag. Thank you.